Hey everyone, and welcome back to another episode of Data Driven Value, where we show you the tools and teach you the skills to help you take your financial freedom into your own hands. So today we're going to cover some news. We got some jobs data. We're also going to take a look at the Bitcoin ETF as well as exchange flows, kind of get an idea of how we're looking at this point in the cycle. And then we're going to finish up with a little bit of coverage on Cleanspark. They just released earnings yesterday, so we're going to get into that. I will look at them, show you guys my Bitcoin miner comparison document again, and really just talk a little bit about Cleanspark, their strategy, their earnings, and kind of our plan going forward. So just to start things off though, we'll get into this economic news here. Obviously we see U.S. jobless data, so dipping to 4%. We see the jobless rate slip to 4%, and they revised the November and December payrolls higher. So we also see January job creation was down from 307,000 in December and 263,000 in November. Economists did expect 170,000 new jobs in January, so kind of missing expectations there. We see average hourly rate wages rose by 0.5% from December and 4.1% from January 2024. So at least, inflation's coming down and wages are starting to go up a little bit. That being said, it's not a massive increase in wages there. So definitely we'll see kind of going forward. Hopefully we can continue to see a bit more wage increase. But again, that's going to kind of depend on the macroeconomic conditions. Obviously, if we kind of have increased tensions surrounding a trade war, prices are going to go up, and therefore their profit margins go down. Essentially, I don't think they'll be passing on the excess money and wages there. So essentially, they're just not going to be able to afford the same kind of raises that they have been in the past. We obviously see here, though, nice to see it rising a little bit while inflation's coming down. Obviously, yeah, it's not good if you see inflation going up and wages kind of stagnant. It just means that, again, you're not keeping up with inflation. So we do see here, though, it came in a bit hotter than expected. This news might be disappointing to the inflation fighters at the Federal Reserve. We've been talking about that. We've basically been saying the Federal Reserve has no reason to cut rates. They've said basically they might do one more rate cut before the end of the year. The very small potential of 2, but this data just kind of prevents them from needing to do anything like that. So now there's the potential that they might not even have to cut rates anymore this year at all, just because of the way inflation's, like as we mentioned, it's a little bit sticky, and the unemployment numbers, they're not concerning enough to warrant a rate cut or an emergency rate cut. So we obviously see the future's cloudy. Federal judge on Thursday temporarily blocked Trump's plan to push out federal workers by offering financial incentives. So we did see basically the current administration offered a blanket kind of offer to all government employees if they wanted to leave, so they could essentially just quit and get paid a severance package, and then they'd be able to just exit kind of their government role. We do see, I think I read that there's about 60,000 employees that are actually considering doing this, but we obviously see here that a federal judge did temporarily block the plan. So we'll see what happens going forward. Obviously, if he gets rid of 60,000 government workers, that's 60,000 less jobs, and it could have an effect on future economic data and therefore the markets. So it's something we're going to be following. We do see here the freeze came after the Labor Department collected the January jobs numbers. So any impact will be revealed in upcoming employment data. That means generally it's not priced in. If this does follow through and we lose 60,000 jobs in the next unemployment data or the next employment data, it's not going to look great. But obviously we see here economists, they're also worried about that trade war against other countries. We've been talking about that for the last week. It's something that we're very aware of, and yeah, we're not really concerned about it at this point, but again, it's that thing in the back of our minds. Therefore, we kind of have to hedge our portfolios. You need to be ready for a broad market drop or retracement. If we see a trade war really escalate, especially a global trade war, no economy is really going to be safe, and everything's going to kind of take a hit. So again, as you want to be an educated investor. So to be educated, you really need to understand both extreme ends of the trade. So again, there is the bullish side of things where we see a very crypto-friendly administration. We're likely going to see a strategic Bitcoin reserve. We're seeing more and more kind of embracing of the general asset class and kind of usage of crypto, and the potential for actually crypto or Bitcoin to be used kind of to track government spending. I think that would be a really good tool. I've said this years ago. I kind of said it to my fiance. I never actually expected it to kind of come about, but wouldn't it be great if we could just track government spending on a public and immutable ledger where they can't change change anything, they can't hide anything. It's all open source and available for you or anyone to review, you know, especially with what's going on right now with the US aid kind of fiasco there. So discovering a lot of kind of misappropriated funds, misused funds, or just missing funds, you know, that's not uncommon with governments. That's something I didn't really realize the extent until I started investing. And then you start to follow the money. And when you start following the money, you really realize kind of how much corruption there is behind all of this. So we do see, obviously, lots of money kind of gone missing or gone to, you know, different entities that maybe shouldn't have received any sort of funding. But I kind of digress in that sense. So we're going to continue on here. Obviously, Canada and Mexico, America's two largest trade partners, remain in the crosshairs. He did give us that 30-day reprieve. That being said, he could come back in a month and basically just demand more and just throw that threat right back on the table. We also see he's obviously itching to slap tariffs on the European Union, again pointing out that major trade deficit with the EU. So that being said, the US is in a major trade deficit with China, Europe, Canada. So it's really, I don't really understand what the point is here, because there's a reason they're in this trade deficit, is they don't have the capacity or the capability to be able to produce the same amount of goods or resources at a competitive price. Otherwise, they would be doing it domestically. It makes no sense. So the fact that he's just using tariffs without kind of thinking about it, you know, he thinks that all these jobs are just going to be easily replaced in America. That's not the case. It's going to take years, sometimes decades, to develop these supply chains. And that's what China's really done. They've really gone throughout kind of all of Asia and the kind of the eastern side of the world. They've really tried to build somewhat of a Silk Road, somewhat of a modern Silk Road. So they're really investing in trade infrastructure. They're investing in the infrastructure of their trade allies. Whereas Trump, on the other end, is literally, he just thinks this is all unfair and the US is getting the kind of poop end of the stick. But that being said, there's a reason. Like, there's a reason that all these jobs, all these goods, all these resources are being manufactured or being extracted elsewhere. And again, it's because it makes more economic sense. So, don't really see the end goal in this. And again, at the end of the day, it's going to hurt consumers, but Trump isn't a consumer. He is a rich elite, and he will likely benefit from the increase of his net worth due to the increase in assets. Essentially, he is able to funnel all the U.S. capital to the businesses that he prioritizes, and he's definitely invested in those. Whereas we've talked on the alternative side, most people are not in a big position where they can afford to put aside lots of capital to invest. It's a very hard time right now. Cost of living's really high. You know, wages, while they are going up a little bit, they're not quite keeping up as much as we'd like to. So yeah, really tough time for the consumers, and a really hard time for investors as well, trying to position yourselves, because on one hand, you've got the elite who are all positioned in the assets, and they want their net worth to go up. So as an investor, you know, this can affect you in a certain way that's different as the way it can affect you as a consumer. So important just to recognize that. But again, generally, this whole tariff global trade war is not going to be good for anyone in the long term, and it could trigger potential recessions in the US. There is technically a recession in the UK, and they went into a recession in Europe. So yeah, there's lots of worrying economic factors to consider. Obviously, see here, the tariffs could rekindle inflation. We talked about that. Still stuck above the Fed's 2% target. So again, no reason for them to cut rates, because they're still above their 2% mandate. And if tariffs push the prices higher, again, this is what we talked about, that Fed having to cancel or postpone the 2 interest rate cuts it was previously forecasting. So again, it's down to about 1 being priced in, and again, that's bad for economic growth and job creation, because it just puts more constraints on capital. So obviously, see, the job market cooled. Payrolls increased by 2.2 million last year, down from 3 million in 2023 and 4.5 million in 2022 and 7.2 million in 2021. So obviously, the labor market has just been continuously cooling year after year. And again, that's just a trend we've been following. But I think they do a good job of kind of representing the numbers in a way that it makes it look better than it is. We've talked about the revisions. I'll get into that a little bit more later on. We do see here employers posting fewer jobs. Monthly job openings have tumbled from 12.2 million in March to 7.6 million in December. I mean, it's still a decent number by historical standards, but really important to see that just half as many monthly job openings almost as kind of what we had in March 2022. And going down here, the Labor Department is also expected to report annually released revisions Friday that will show job creation from April 2023 through March 2024 wasn't as strong as originally reported. That's what I've been saying. They revised these numbers down later after the fact, so get ready for that. Obviously, the headline numbers, I take those with a grain of salt. I do know that they are propped up slightly through different ways, different kind of tricks, little accounting tricks they have. But obviously, a preliminary version of the revisions showed that 818,000 fewer jobs were created over those 12 months, and the average monthly hiring during that span went down to 174,000 from the reported 242,000. So quite a large revision when you think about it. Essentially, 25% revision down. That's pretty crazy. Essentially, so the government is putting out these numbers and making them look a lot better than they are. We've just seen that in all the revisions. Something we do have in the back of our mind. We're still following it going forward. Obviously, they want to try and present this so that the economy looks strong on paper. And as long as it looks strong on paper, they're going to keep kicking that can down the street. We've talked about that. So we'll just keep following that. And again, we're just following the charts. We're following the data. And then we're making the decisions kind of based on that data, not letting the emotion take advantage of us. Flipping over here, we'll get into the Bitcoin ETF net inflow here. So obviously, spot Bitcoin ETFs have been a major catalyst in driving Bitcoin to the current prices. We do see here it's had crazy inflows, all the inflows surpassing BlackRock's gold ETF in a fraction of the time. I think it was less than 10% of the time it surpassed the gold ETF. So really crazy amount of institutional demand and adoption for the Bitcoin ETFs. We do see here we did have an outflow of $140 million worth of Bitcoin yesterday. So interesting to note, obviously we don't see a trend of outflows. So like when we get into here and here, you see when we start to develop these outflow trends, that's where price goes into these consolidation phases. That being said, that generally offers good buying opportunities as well. So we'll follow this. If it goes into a bit of a trend here into selling, maybe we get a bit of a buying opportunity. But if we flip down here, just breaking down the numbers kind of total here. So we have the total spot Bitcoin net inflow. We do see here, so yesterday, minus 1.45 thousand Bitcoin. So they sold 1,450 Bitcoin, but kind of just mixed results through across the board. You do see generally we're adding more than we're selling, and you see a total kind of net cumulative holding of 575,000 Bitcoin within spot ETFs. So ETFs are still capturing a lot of market share. Pretty crazy how fast they've grown. Again, we're just going to keep following them. Continue on here. Take a look at the transfer count net to exchanges. So this is essentially Bitcoin being sent to and from the exchange. And I just want to show you this because we're going to take a look, kind of gauge how we're looking at a cycle perspective. Obviously, you see when this peaks in positively kind of way up here, same through here, go through these sustained periods of Bitcoin being sent to the exchanges. That's generally when price kind of comes up and tops. You see it topped right here. You see with this peak right here lines up with that peak, and you see this peak here lines up with the second peak. So obviously, just looking at our current situation here, we're not quite there. Obviously, look at this. So through the bear market, all this sustained kind of buying. So lots of people buying, taking Bitcoin off of the exchanges through here. If we do see this flip and start to push up and show a bit of a trend similar to this, look for that kind of look for that divergence there, or that convergence kind of with the price here. And again, obviously, we're recognizing those major spikes and flips to kind of all the inflows to exchange typically do coincide with market cycle tops. So just something we're watching as well. And then we'll take a look also at our indicator risk dashboard here for crypto. Obviously, everything kind of, middle of the, kind of a little bit less than neutral risk here. Looking at kind of different metrics broken down. So obviously, kind of our social metrics are very low. There's not a lot of normies, is what we call them, kind of people who aren't used to Bitcoin and crypto. They're still not here. They're not paying attention yet. We do see social interest really skyrocket when we start to see a typical mania phase. That being said, I've kind of just put out the argument that a lot of retail investors are not able to afford to invest in assets, and for that reason, they're not going to be able to invest in even more speculative assets. So you really have to kind of you have to have that safety cushion, as well as the additional excess capital and kind of the risk tolerance to be able to come into the space and kind of handle the volatility in here. So obviously social risk quite low. Some of our other on-chain metrics getting up there kind of in the more elevated category, but still not kind of near our traditional cycle top overheated nature. And then same thing over here, looking pretty good. Bitcoin fear and greed a little bit overheated. That being said, it does go through periods of over and under extension on the fear and greed index, and it can stay overextended for a long period of time, as well as price can really climb a lot more. So just basing things off the fear and greed index isn't always the best idea, but generally we can just see, we're kind of just in the middle. I call it no man's land in the cycle right now. We're not really sure what's going to happen next, but just maintaining our exposure and managing our risk and getting ready for opportunity. Flipping over, we're going to cover Cleanspark earnings. So Cleanspark stock rises following strong first quarter earnings. They're up like 15%. It was about 20% at one point. Beat earnings by a crazy amount. So we'll just get into that. Obviously, we see here they announced an earnings per share that exceeded analyst expectations. Basically, they had an EPS of 83 cents. The analyst expectation was 17 cents. So just beating it by a massive margin, just insane beat there. They also had a significant increase in revenue, net income, also improved operational efficiency and reduced their cost to mine Bitcoin. So amazing job from them from both a financial and a production standpoint. We see here the revenue for the quarter was reported at 162 million, surpassing the estimate of 153 million and 120% increase from the prior year. So huge increase despite a halving effect taking place. Cleanspark's really been able to scale their operations, bring down that efficiency, and really drive up their revenues. So really good job from them. We see here that net income almost $247 million or 85 cents per basic share compared to the 14 cents per basic share for the same period in the prior year. So again, massive growth year over year. We saw their adjusted EBITDA raised to 320 million from 70 million. So again, these are massive increases in these metrics, guys. Like, this is why I've been beating the drum on Cleanspark for years, because they continue to execute from a financial and a productive side of things. So again, we see their 42% quarter over quarter increase in deployed hash rate, insane. Also pointed out that they grew from about 10 exahash to 40 exahash last year. So just insane growth from Cleanspark. Really good consistency, really good execution on their growth strategy, consistently outperforming their goals, whereas other companies would actually miss or underperform. So Cleanspark's really showing everyone else kind of how it's done. Make that strategy. Don't overpromise and underdeliver. Do the opposite and do it consistently. So we see here also a 20% improvement in fleet efficiency, 6% reduction in cost to mine, bringing it down to 34,000 per Bitcoin at their wholly owned facilities, which is the majority of their facilities. They do have a very small percentage that they're still kind of working on fully integrating as well. So they will be 100% fully integrated in the future. Still working towards that, but basically majoritively self-integrated. So really good job from them. And their 14% reduction in total operating expenses. So really good job. And then we see here that Zach Bradford exceeded the 2024 guidance. So initially they had a 32 exahash target. They smashed that, finished the year over 39 exahash. Their new goal, 50 exahash in the first half of 25. I think they're going to smash that as well. Basically, they're already above 40 exahash. They've got an additional 147 megawatts I'm kind of anticipating to be available to start hashing kind of in the coming months, and it should add between 5 and 8 exahash. Kind of just to use based off their commentary as well as some back of the napkin math. So obviously they do have that potential to hit that 50 exahash target and then expect it to get revised or at least improved for the back half of the year. I wouldn't be surprised, especially to see them kind of end anywhere from 60 to 75 exahash at the end of the year, depending on the opportunities that arise. We do know they strategically acquire their assets, so they're not looking to over risk, just take advantage of strategic opportunities and focus on the production and the fundamental side of things, and then kind of just follow that strategy and just keep executing on it. That's what Cleanspark's done for years, and it's what I expect them to continue doing for years. So obviously they have $2.8 billion in assets, $1.2 billion in total liquidity, and their Bitcoin treasury has grown to over 10,500 Bitcoin, all mined within the United States. We'll flip over here now, and this is just to kind of talk, I want to talk a little bit about their growth strategy here. So just touching on this, kind of how they're going to get to that 50 exahash there. And yeah, they've always done a really good job of executing their growth strategy, so I expect the same. See here, next major milestone, 50 exahash. Foundation for this growth was in late January of last year. They secured 60,000 S21 miners with an additional option to acquire 100,000 at the same price. So this is what I talked about them. They secured this option for miners at kind of record low prices, or like bear market low prices. If you go try and buy these miners today, the cost is going to be 37% higher, and it's really going to eat into your profitability. It's going to eat into the ROI of those machines as well. You do have to pay off the cost of the machines. It does take time, so the more you're spending per terahash on those rigs, the longer it's going to take for them to pay off. So really good job for Cleanspark securing all the rigs they needed necessary to meet their goals. We do see with these units secured and financing in place, they're advancing their greenfield development and facility across 5 sites in 4 different states. Their auction contract also provides the flexibility to scale down 60 exahash at a cost of 21.50 per terahash. So again, that's significantly below the spot price, which is currently 37% higher. So good job securing these deals beforehand, because they really do pay off during times of euphoria or in the bull market when prices really start to go up. So we see here the infrastructure required to achieve the additional 10 exahash necessary for mid-year target already sourced, including transformers, power distribution, low voltage components, and additional immersion cooling infrastructure. So they've already got everything basically sourced to support their growth strategy. So going forward, just expecting them to continue executing on it as always. Construction's already underway in Tennessee, Wyoming, and Georgia. And while mergers and acquisitions aren't necessarily required to reach 50 exahash, they remain disciplined in evaluating strategic opportunities. So again, if they think it makes sense to buy a turnkey data center from a distressed miner or other kind of situations like that, it may make sense for them to acquire those assets, and they're definitely interested in doing so. I'd like to see them continue doing that as well. But again, they're not. They're only going to do that if it's accretive or if it makes kind of financial sense to do so. They're not going to pay a premium for a data center. It's just not within their strategy. So we see here again, this is what I just talked about. Acquisitions often come at a premium, can be capital destructive. Assessing opportunities to selectively, particularly those involving companies with strong power contracts but low efficiency fleets. So a lot of miners, they might have an old, outdated fleet. It's not very profitable anymore based on current mining economics. But they'd have the data centers, and they need to outfit those data centers with brand new kind of rigs. They can enter a somewhat of kind of a beneficial agreement with Cleanspark, or they can. That's kind of what they did with grid infrastructure as well. Acquire their sites and then put their miners in place of the older miners, and then you've put that hash rate. It's like turnkey. So if you can get turnkey facilities, it's going to be way faster to get hash rate online, making you more competitive in the near term. We also see small scale sites where operators face constraints, kind of upgrading their fleet, or lack of access to capital. So again, these bigger players can really help some of the smaller players by upgrading their fleets, having more access to capital, a bigger expansion pipeline. And then again, they do have kind of the ability to go beyond 50 exahash. We're expecting that to be a sandbag number. Focus on disciplined growth, operational efficiency, and strategic expansion. Fully integrated model not only optimizes site performance, but also mitigates the counterparty risk that has challenged the industry. Obviously, repurposing a Bitcoin mining data center for high performance computing is very complex. You have to redo all the not the infrastructure, but you kind of have to rebuild all the setup there, the racks, to house the chips for AI compute. It's not the same technology that is used to run these Bitcoin miners, so they're going to have to change that if they were to go that route. So that's kind of why Cleanspark's just been the pure form Bitcoin miner, and they've done an amazing job of it. So obviously they're going to start generating revenue way faster by kind of bringing Bitcoin mining sites online as opposed to HPC sites. And again, they're just going to focus on high return strategic opportunities that align with their core strengths. It's what they've always done. It's what I expect them to continue doing. It's why I invest in them, and I continue to do so going forward. So we'll flip over here to our Bitcoin miner comparison document. We did touch on this yesterday. So obviously, based on an efficiency standpoint for the first month of production, they're up there in kind of the top tier of the miners. 626 Bitcoin. They did have to curtail operations for a few days because of weather, so they're able to kind of support the local economy, but still produce an amazing amount of Bitcoin. Just following them going forward. We'll get down a little bit into kind of our valuation metrics here. So this is about production. Obviously, green is going to be better. You see, of all the miners that I track, I have Cleanspark ranking in the top tier. So basically, I compare all these miners against each other, and then I kind of have a standard for who I rank as the top tier, middle tier, and lower tier, and that's how I've color coded it, so green, yellow, and orange. And obviously we see Cleanspark just pretty green across the board here. The only thing that they're a little bit lower in is their implied growth, but that's because, again, they sandbag those numbers, so I expect them to kind of revise that 50 exahash target a lot higher and kind of, target bigger growth for the year. But, they're definitely up there in terms of production, consistency, efficiency. That's what I talk about, the fundamentals. We look here at our share price, like valuation metrics, and again, from a comparative standard against the other miners, looking really good, looking really valuable, really relatively undervalued. We did see Cleanspark. They went and outperformed for the majority of 2023, and then they went on to kind of a bit of a period of underperformance. You can't go through these times of overperformance and not underperform at other times as well. That being said, while a lot of people got scared and kind of chased different investments, I just focused on buying when it seemed cheap. And that was the right call, because I'll show you in a minute when we get to the chart, how it looks. So obviously, flipping over to the institutional investment, you can see since the bear market lows, basically institutional investment in Cleanspark has only been rising. So the institutions are bullish on Cleanspark. They're buying here, but the retail is selling here. So I saw a lot of retail scared, sell out of their Cleanspark position. They thought it was just going to keep going down. They don't focus on fundamentals. They were focusing on near-term irrational price action. That's not what we do. We focus on the fundamentals, and we buy when valuations are cheap, and then we wait patiently. That's what we did again. And if you followed me, if you're in my Telegram group or followed some of my recent videos, you should have been able to kind of recognize that value there. I did publicly mention that I was DCAing into Cleanspark for that reason. So obviously here again, institutions still buying. I'm still buying when I can. Obviously not right now on a day like today. We'll flip over to the chart here, just looking at it from our momentum indicator. So we did see we came here very oversold on the daily, on the MACD. We have a good, nice setup here on our DMI. We want to see this red 80X line start to curl up, really support that push up for the blue DMI plus. We see that bullish cross on the stock RSI. We see the whale money buy indicator stepping in right here. So they've been buying at $10.50, around $10, 10.50 cents. So that's where I was buying as well. I'll show you in a second here. And we see our technical here on the daily. We're looking at a strong buy. On the monthly, we're looking at a buy. A little neutral on the weekly for now. So we'll see what kind of happens. But, looking really good from a momentum standpoint here. We did see we've broken out of this 3-month downtrend that we were in here. So we're looking for that higher low entry. Again, this is where we targeted our entries for Cleanspark. If you follow me or my miner posts, my accumulation ranges, this is where I said Cleanspark was worth buying. And look at that. If we look at just a percent from this range, from the bottom of the range to the current high right now, 25% move, even just to here, a 15% move. So really good job. Again, the Fibonacci levels with confluence of horizontal support, picking that low. We've broken out. Look for that higher low here in this kind of low time frame, Fibonacci golden zone. I'll zoom in for you right here. But yeah, so look for that little retest. So that's what I talk about when we break these downtrends. Generally we're going to come back. Look at that, rejected right in here into this order block. So I think what we need to do essentially is come back, retest this zone down here. Maybe retest the top of this horizontal support zone. So if we go under $11, that might be a good swing position in Cleanspark, assuming this trend is going to continue to the upside. But looking really good. Our analysis has played out as usual. So yeah, we're just sitting on those buys. We're also sitting on our cycle position, and yeah, we'll just wait and see what happens. Hopefully we are able to maintain that uptrend structure and then continue to the upside. But that's it for today. I know it's a little bit stretched on there with the earnings as well. Tried to get through it all really quick for you, but I wanted to cover everything as well. If you learned something new, please like, share, subscribe, and otherwise I'll see you guys tomorrow in the next one. All right, bye.